Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to this episode of the Simply Financial podcast. I'm your host, Christopher Calandra. This is episode 49 of season 3. Today's discussion is about year-end planning for investors, and agenda is pretty straightforward. First, we'll begin with an economic and equity market update. Then I'd like to discuss some of the year-end tax planning strategies that you can consider. These are strategies, if you're our client already here at Elliott Wealth Management Services, that we're going to do. But if you're not a client of ours, keep this in mind because it's an important way to help be successful as an investor. Before I begin, though, it's important to review that there are 5 key areas of financial planning: preservation, retirement planning, investments, tax and estate planning. We are here at Elliott Wealth Management Services, a comprehensive financial services investment advisory firm. And we are always going to consider the impact of our recommendations in not just one of these areas, but in all of them. So please keep in mind that my discussion today is primarily on the economic outlook and some year-end tax planning ideas, which could have an impact on some of your financial planning decisions. But this podcast episode isn't going to cover all of them. So year-end planning can be very helpful. As you know, taking the time now to assess your financial situation and discuss potential year-end financial strategies can help reaffirm your financial plans. My philosophy is that it's always helpful to review the coordination of your estate plan, retirement, and investment plans along with your tax plans to have a coordinated effort to build wealth and make smart financial decisions. At that point, then, you can see if your time horizons and risk tolerance are still aligned with your goals. This time of year, as of this recording, it's late November. This episode will probably be published in early December. At this time of year, we want to try and focus on year-end strategies with our clients here at Elliott Wealth Management. So let's just talk about a quick, broad overview of the financial markets movements so far in 2019. We have had a fabulous year in the market. You may remember that the fourth quarter of 2018 was really rough. We experienced a significant sell-off, especially in December of 2018, which was the worst December since 1932. This year, the market has rebounded. A lot of the concerns that hurt the market in late 2018 did not materialize. And we have volatility. It's been a volatile year, but it's been a very successful year with markets hitting all-time highs several times throughout the year, including here in the latter stages of 2019. Even though this year has been a very strong year, I want to remind everyone, and if you've worked with us for a while, you'll hear me talk about this a lot, is volatility is a part of investing. So as excited as we are about this year's success, we do want to proceed with caution because the markets are still volatile, and there's some strategies that are good to keep in mind and to implement as you plan, not just at year end, but in general. So a couple of keys. Try to keep things in perspective. Avoid making emotional decisions. One of our key roles in working with clients is to remain unemotional, keep a long-term perspective, and have an awareness of historic norms to help our clients make smart, informed decisions and ones that are not emotional. Also, beware of media magnification. This is a topic that really strikes close to home for me. I feel that the media doesn't do a good job of providing information to the public, and at no point in time is the media really trying to help you make good financial decisions. They want to have a lot of drama. They want to draw you to watch, draw you to click in, but they're not trying to help you make good decisions with your money. That's what your financial advisor is for. This is a good time to recheck your risk tolerance, recheck your time horizons, and you want to focus always on your goals. In thinking about this year's success, I want to just remind everyone that one of the key things that has happened this year is that the Federal Reserve, led by Federal Chairman Jay Powell, have really changed their outlook on interest rates. Not just their outlook, what they've actually done. I've talked about this in several episodes this season. I did an episode on the Powell pivot, which was episode 32. Then there was the pivot to uncertainty, episode 33. And the pivot continues, episode 39. All three of those episodes was focused on interest rates. But what I just want to briefly say here is that last year in October, the Federal Reserve was expecting to raise interest rates in 2019, maybe as many as 4 times. That did not happen. In fact, what did happen is that the Federal Reserve has decreased interest rates several times this year. That's an enormous change, and that has created a wonderful environment and led to some of the factors that have helped the market do so very well this year and reach all-time highs. One of the things that I wanted to touch on now is the term recession, because you hear that a lot. A recession is defined as 2 consecutive quarters where the economy contracts or shrinks. So the U.S., as of this recording, is in the midst of its longest economic expansion in history. It hit the 10-year mark in June of this year, so we're coming up on the 10.5-year mark. And although in the media there's been lots of talk about a recession possibly taking place soon, my view, our view here at Elliott Wealth, is that the recession will eventually arrive, but that's not likely to happen before the presidential election in 2020, maybe 2021 or 22, but it's not something that we see happening anytime soon. And in terms of recession, just as an education component to this discussion, let's talk about the business cycle. The business cycle is the upward and downward movements of the gross domestic product of the United States. And we're referring to periods of expansion, like we're in now, almost at the 10.5-year mark, and periods of contraction, which are recessions and or depressions. And these periods of expansion and contraction can last for several months or for several years. A prime example is this expansion lasting 10.5 years. The business cycle consists of 4 phases. There's an expansion. Next, you get to the peak, which is the top of the economic cycle. That's followed by contraction, where the economy shrinks, it fails to grow. And then the trough, which is the low point that the economy will experience before it gets back to expansion. From a historical perspective, we have had 5 recessions since World War II. From 1973 to 1975, we had a recession, a pretty severe recession, that was probably, most historians believe, caused by the oil embargo coming out of the OPEC countries in the Middle East. Next, we had a recession in the early 1980s, 1981 to 1982. The cause of that was probably inflation as well as rising gas prices. Next, we had a recession in 1991. The cause was related to the first Iraq war. Iraq invaded Kuwait, created a lot of unrest. We also saw a byproduct of that unrest was once again rising gas prices. It was a pretty shallow recession. It didn't last very long. It wasn't very deep, but that was 1991. Then in 2001, we had another recession where you had what's called the dot-com bubble. You had the stocks of tech companies in this dot-com boom deflate, and that really hurt the markets. And we had the attack on 9/11 that caused harm to this country's psyche, as well as it was an attack at our financial system, having hit the Twin Towers in New York City. So that was the cause of the 2001 recession. And then 2007 through 2009, I'm sure all of my listeners remember that, the Great Recession. The cause there was the subprime mortgage crisis. It was also coupled with high gas prices. You see a little bit of a trend. All of these were related to gas prices as at least a contributing factor. But we had 5 recessions since World War II. We're going to have one again, as I said a few moments ago. But we will not have one, in my opinion, in 2020. Again, sticking with the jargon, a correction in the stock market is traditionally defined as a drop of at least 10% from a recent high, and a bear market represents a decline from a recent high of 20% or more. Since 1950, the S&P 500 has undergone 37 separate stock market corrections of at least 10%. Considering that that's over 69 years, that means on average, the markets have a correction every 1.87 years. I got this data, by the way, from the Motley Fool, some research they put out in May of 2019. So this volatility happens whether you have an economic expansion or whether you have an economic contraction in general. Sometimes people think that the market's only going to be volatile when you're getting to a recession. History shows that that's not a good assumption. So let's talk about some of the concerns in the market. We've had this wonderfully powerful year with lots of markets hitting new highs. Our investors have experienced really good returns, whether they are conservative, moderate, or aggressive. It's been a fabulous year. But there are concerns. I've talked about these on many of this year's episodes, and they will continue to play into our thinking as we try and help our clients achieve their financial goals. We have the ongoing battle with China over tariffs and trade. There's a lot of political uncertainty. Currently, the House is debating articles of impeachment against President Trump. That uncertainty does weigh on the economy and on the markets. I don't think it's the leading topic that the markets are concerned about. I think the issue with China is far more important, as is the interest rate environment. And then lastly, I'll mention we have issues in the global financial marketplace. You have Brexit in Europe. You have a European economy that continues to struggle and lag behind the United States economic growth. You have unrest in Hong Kong, where if you watch the news, you have protesters in the streets, including some violence. So there are some global financial issues that need to be monitored. As we come into the end of the year, we think that this is a good time to consider rebalancing portfolios. We, for our clients, have rebalanced portfolios frequently during 2019. It was the same in 2018. In our core allocation process, our clients have experienced 7 portfolio updates this year. No, check that. It was 6 this year. We did 7 in calendar year 2018. So we continue to monitor the markets and rebalance our clients' portfolio, taking